Hi, I'm Dr. Kevin Milo, and you're listening to the Physician Empowerment Podcast. At Physician Empowerment, we're focused on transforming the lives of Canadian physicians through education and finance, practice transformation, wellness, and leadership. After you've listened to today's episode, I encourage you to visit us at PhysEmpowerment.ca, that's PHYS, empowerment.ca, to learn more about the many resources we have to help you make that change in your own life, practice, and personal finances. Now on to today's episode.
Well, welcome everyone on a Monday night, and it's always good to see you guys. And so it's Kevin there, me, and Gaurav. So I'm Wing Lim, Dr. Wing Lim, and this is Dr. Kevin Milo, and that's Gaurav, our guest. So welcome everyone. There are other people might pop in later. Yeah, so we're super excited to be hosting this webinar, live webinar. And the etiquette is we record the show, and so that you guys know it's being recorded. So I'm one of the co-founders of Physician Empowerment, and what we do with the live webinar and the podcast is we interview interesting people on interesting topics that might help physicians live better lives. So we're here to do all that, and so tonight I'm super pumped to have Gaurav to be our guest. And Gaurav is interesting for many, many reasons, and we'll dive right into it. But Gaurav is a physician's husband, so this is one of the spouses. But he's got a very diverse background. So maybe tell us a little bit about your immediate family or extended family, how you linked into the physician community.
Sure. So thanks, Wing. So I like to joke that I come from an East Indian background, lots of medical doctors and that from that background. And so my parents wanted me to be a doctor. So I did the next best thing and married one. My wife, she's a family physician. She's been a family physician, I think, since probably 2015 is when she finished her residency. She works out of the clinic. We don't run the clinic. She just works out of a clinic, her family there's a few doctors in it. Her mom's a doctor, and so is I think her cousins as well.
Right, and then you got some on your side, right?
Do I? I'd have to think actually. I'm not sure actually if I have too many on my side.
Right. Yeah. But it doesn't matter, right? We're all regular people, anyways, right? It doesn't matter what profession we are. So now, professionally, you have a very interesting background. You're CA, CPA, CFA. That's quite a designation. And you have institutional background, and you're not. I guess you don't want to be stuck behind a desk doing people's tax returns. So you do a lot of things, and you're into financing as well. So tell us more what your journey is like.
Yeah, so I went to school in Waterloo. I actually studied biotechnology and chartered accountancy. So I was kind of hedging my bets, thinking maybe I'd go into medicine. So I worked for Deloitte, which is a international accounting firm. Co-ops there. It was good. I liked it. Gave me a good investigative background. But kind of always knew I wanted to move to finance. Decided to move out to Edmonton to join a sort of mid-sized and growing pension fund, Alberta Teachers Retirement Fund. Right. And didn't really know much about finance really until I got into there. And we were doing private investments. The program was, I would say the book was, it was a $3 billion book where that's what we were building. Wow. Half was private equity, half was infrastructure. And I worked primarily on the private equity side. Yeah, we were investing in funds and co-investments, and it was fun. It could have had a very cushy job, but decided that I wanted to kind of do more entrepreneurial things. So I, long story short, I joined a private lender. That's where I kind of got my experience in real estate. There for about 4 years, kind of originating deals, mortgage deals, right? Again, probably prior to that, really didn't think of mortgages as investments, right? And then decided I wanted to get some CMHC experience, which is related to multifamily. So I joined a national real estate finance firm, learned multifamily financing, CMHC. And then now I've kind of become, independent. I am technically a mortgage broker, right? I like to think of myself as more of a sort of a consultant, I put together my own deals as well, equity deals for real estate as well, because I think that's where my passion lies.
Right. So that's really interesting background. And so, of course, you're more qualified than anyone. But what you just said just caught my attention, right? You said you learned about private equity and about real estate quite a few years after you became a CA, right? So that tells me that the CAs that we use, if they're the general practice kind of CA, they might not know a lot about this stuff, do they?
Yeah, no, you're totally right. Like when I was a CA, right, and doing audits, right, I would say my Excel skills were pretty limited as well, right? I think now, with new CAs, that's improved. CAs, they know numbers. Some of them, even within CAs, some of them know taxes, some of them don't. There were some CAs who were auditors who didn't even do their own personal tax returns, right?
Right.
So I think obviously just like physicians, CAs come in different kind of backgrounds and experiences,
right?
Just as finance advisors do as well, right?
Yeah, it never ceases to amaze me how my colleagues, and I met a lot of physicians East and West Coast, they always run business ideas by the accountants.
Usually they'll tell you no then if it's their accountant, because they're generally pretty risk adverse, right? And
they're very risk averse. They'll shoot down your idea, even if it's a good one, right? So anyways, that's just for what it's worth, right? Do not go to your accountant for business advice. Go there for your tax return advice, right? So, yeah. Okay, so let's move on. So when we talk about private equity, let's talk about public markets, right? There's public, there's private. And most people just don't give the money to advisors. And most physicians I know of have thrown the money into public markets. And it's a mess out there. So do you want to make some comment about the reason those bank runs, stocks, bond reversal, crypto upheaval? Can you just get a broad brush? What's the weather like? What's the temperature like out there in the public markets?
Yeah, no, I mean, so obviously there's a lot of volatility, right? After COVID, when COVID hit, the markets took a big dive, right? And then there was a big run up, right, related to all the printing of money, right?
Mm-hmm.
Now they're kind of out of favor again, right? The markets have taken a hit with just interest rates rising, right? Tech has definitely taken a huge hit, right?
Mm-hmm.
And now there's definitely recession fears, right, coming. So the yield curve is kind of changing, by the month, right?
Mm-hmm.
And especially with these banking failures with SVB and now Credit Suisse, like people are worried, like, is this another 2008, right?
Very much so.
So there's definitely a lot of volatility. You're seeing that in the bond market for sure.
Yes, exactly. So historically, people say, well, 80-20 rule, 60-40 rule, 60% stocks, 40% bonds. Oh, you're set. Well, gee, if both of them tank, what do we do if that's a retirement?
Yeah, me personally, like I think capital should be, flexible. I'm not saying, public markets are bad, but sometimes, there's sometimes a time to invest in them. And sometimes there's better times and sometimes there's worse times. That being said, I think you look at the Canadian pension plan model, right? And Canadian pension plans are really pioneers globally when it comes to investing, right? They tend to put a lot of money into alternatives, right? Mm-hmm. And I would say the three big asset classes are private equity, infrastructure, and real estate. Mm-hmm. So definitely that has a place in someone's portfolio. And, there is a trend towards, making this more widely accessible, right?
Right.
But yeah, you definitely have to understand sort of what the risks are. And, private equity, again, very broad term, right?
So before you go further, because treat us like grade 8 in finance language, right? So what is private versus public? Why do they call it public versus private? What distinguishes them apart?
Yeah, so private and public, I mean, the simple difference is that, public is it's openly traded on an exchange, right? Mm-hmm. There's generally more regulation there, right? Like, mm-hmm. To go public, like there's a lot of securities documentations that have to be filled out. Whereas private can be, although there is securities regulation associated with private, it's not as regulated, right? Mm-hmm. And yeah, it's privately owned, right? And
right. So why people go into private equity versus public? What's the advantage there?
Well, I think there's a few things, right? So one is control, right? When you invest in a public security, well, especially if you invest, let's say, through an EFT or a mutual fund manager, right? Well, that manager does not have really any say or control over that company, right?
Right.
Whereas, if you invest in private securities, whether you're doing your own or you're investing with a manager, they're generally going to have more control, right? So that's one reason. The second reason is, there's diversification, right? There's like the universe of there's lots of public companies out there, but there's way more private companies out there, right? So, if all you do is invest in public, then you're missing out on a segment of the market, right? And then I would say generally private investments, they tend to, they have outperformed, right? And that's another reason. There is potential for more alpha because of the fact that there is control, and also because you might be investing in different, smaller, mid-sized companies or projects, and that could eventually go public, right? Through consolidation, right?
So let's back a little bit, because we're afraid of jargons. So when you say more alpha, do you mean that there's more profit and
there is potential for more profit? There is potential,
right? And then that means that potentially there's more rate of return because people go to private. At least I know people, myself included, go there because the rate of return is more attractive.
There could be, yeah. Now, I will caution that part of that return comes from leverage as well. Like the public markets hate leverage, right? So like if you look at like a public REIT, for example, right? They're definitely not going to put as much leverage on the asset. Now they'll say it's because of risk, and there's probably some truth to that. But part of it is just if they put too much leverage on it, they're punished by the public markets. You don't have that issue in the private markets, right?
Let's backtrack. By leverage, you mean they actually borrow some money?
Yeah, they borrow. Yeah, typically private investments, there's more leverage involved, right? Which leverage, it can be in the right instances, it can be a good thing for returns.
Right. So what other things should we consider, like say the downside or the cons of private investment that we need to watch out for?
Yeah, I would say one con is that it's not as liquid, right? So, when you invest in a stock, if you need to sell, you can sell immediately. Now that can be a bad thing too, because sometimes you're your worst enemy, right? So
Chicken Little.
So yeah, I would say if you're investing in private, you have to have a longer term horizon, right? You shouldn't be investing funds that you're going to need anytime soon, right?
So what kind of horizon? What months, years, decades? What are we talking about?
Well, definitely years for sure. Like obviously it depends on what you're investing in, but the thing is, like public, you can literally, I buy something today, I can sell it tomorrow. I might sell it for a loss, but I can sell it tomorrow, right? Private securities, you don't necessarily have that liquidity. We can probably for another conversation, there is a whole area called secondaries in the private markets, which does provide liquidity. But that's probably too much for this conversation at this point in time. In general, private securities are less liquid. The other thing is transparency. Now, depending on the group you're investing in, right? Like it's less regulated, so there's going to be there can be less transparency around it. With public, you have to file your statements quarterly, right? You're dealing with the regulator, right? Private overall is just less regulated, and there can be less transparency. Like you could just get into a deal with for example, a local developer. There could be very limited transparency around it, right?
So in your experience, what's the split? Like most people, do they do like 80% of their money in public, 20% in private? What's your feel, like average professional?
That's a tough question, but I would say it really depends on your own personal circumstances, right? And your need for liquidity, right? That being said, I don't think you should be 100% in privates, right? I think the public markets there is a role for them, right?
Right.
And so I would say what I can tell you is that, like, for example, the pension fund that I worked for, we had 35% in privates, right? So 10% was in private equity, 10% was in infrastructure, and 15% was in real estate, right? So I think if you look at a lot of the pension funds, you can pull up their reports, right, for Canada, Like I would say they're anywhere between 30 to 50% in privates.
Right. I think for most physicians, we don't do day trading, right? We don't have time to do that. We're long-termers. We're building up the nest egg for retirement for us and for intergenerational wealth, right? So for long-termers, so you think it's a good idea, right? Because these are longer horizon, like you said.
Well, I think physicians, like the advantage they have is like, especially in Canada, they're generally if you're a physician, you're a physician for a very long time period, right? You have very predictable earnings, right? And it's almost like a bond, right, in itself, right? Like that cash flow stream, right? So because of that, you can probably rely on that more than, so I say, other professions, right?
Right.
There definitely is a case to be made to invest more in private securities.
Sure. So let's dive into it. So how can an average Joe get involved into private securities, and where do they find them? What kinds are out there?
Yeah. So I mean, some of the private wealth managers or investment managers, they may have a private offering, right? I will caution you that, sometimes these guys are just trying to sell private securities for the sake of, like, almost as, well, I'm not sure what the right, I don't want to use the word gimmick, but they're just like, okay, we know private securities is hot. Let's get these guys into private securities, but they don't necessarily know how to do, actually, honestly, the proper due diligence, right? Is one. And frankly, they probably overly diversify. So when I was at the pension fund, for example, we actually ran a very concentrated private equity book where we invested inside fund managers. And then we also did direct deals alongside the fund managers. And the reason we were concentrated is because if you have, like, let's say 40 managers that you're investing in, well, they're going to have multiple funds that invest in, 8 to 15 securities, companies each, right? So that's just like, you're just overly diversified. You're probably going to end up, after all the fees are said and done, you're just going to end up getting like an ETF type return, right?
Well, that's exactly, I totally agree with that. And actually, it's not just me. So last time we interviewed Brandon Carson, he's a portfolio manager, and the podcast just got released. And so we asked him, I actually interviewed him end of December and say, where's 2023 going, right? Where's the public markets going? And he's just saying exactly that, because it is a zoo out there. So he says, if I were to predict where Fortune 500, half of this is going this way, half of that going that way. And if you just do a very broad-based diversification, like index fund, right? So you end up with the very mediocre thing, which is, not much different, right? But then if you become more selective and you're not just picking average Joe, you actually need to understand what they do, right? And become more select, more focused, right? Then you'll probably win, right? So I guess that applies to private equities then, right?
No, definitely. Yeah. Like, so that's one thing to consider, right? You don't want to be overly diversified either, because if you're trying to, one of the reasons to invest in private is to get that additional return. And if you just end up overly diversifying there, then it kind of defeats the purpose, right?
Right.
And honestly, you have to just, depending on who you're investing with, right? Like you might be able to find like a manager that you can invest directly, who invests in companies, right? Or you can invest through what is known as a fund of funds, right? So the fund, they create a fund, like a feeder fund, which invests in a variety of managers, right? And honestly, selecting the right manager to invest in, there is a skill to that, right? And there is a process, right? But if that manager is investing in, your fund of fund is investing in too many managers, and then they're laying on too many fees, right? Then again, you're just going to end up with an ETF return, right? So
right, exactly. Now let's pivot and move into that space, into more day-to-day who would end up buying those funds from, right? And there's one of the hot, at least in my experience and in my space, but one of the hot thing is real estate, right? Real estate funds is part of this private equity, and they're a big chunk of this real estate. And so I think you and I both passionate in this space, right? And there's a lot of capital raised, there's a lot of good returns. So how would you describe this space right now? this real estate fund space? Is it expanding? Is it worth getting into?
Oh, definitely expanding. The whole alternatives is expanding, and real estate is probably, I haven't looked at the statistics, but it's probably one of the largest private asset classes, right?
Mm-hmm.
And there are more private funds kind of showing up, right? Yeah, so you could find a manager to invest with. You could find a sponsor to invest in. You could go through an EMD as well, right? EMDs have different products on their shelves, right?
Right.
But again,
let's talk about EMD. That's a good catchphrase, right? So what does the EMD mean, and what do they do?
Yeah, so Exempt Market Dealer. I was actually formally registered as an Exempt Market Dealer back in 2015. And I'll be honest, I didn't fully understand it at that point. I was maybe 25, 26. I just had the right credentials and someone got me registered. I got to learn about this space a lot later on, right? And I think I have a better appreciation for it. So yeah, so EMD is a Exempt Market Dealer. My understanding is these are groups that are essentially allowed to raise capital in the exempt market space.
So why exempt from what?
From a prospectus, right? So when you're raising capital, there's if you raise capital in the public markets, you have to prepare what is known as prospectus, right? Which is essentially a legal / marketing document, right? To go public, right?
Right.
When you raise money in the private markets, there's various exemptions that you can rely on to raise that capital, right? And one is friends and family, another is the accredited investor exemption, right? And so I would say EMDs, one from an issuer point of view, from like a sponsor point of view, if they're raising capital on a very frequent basis, then I believe they need to use an EMD, right, to stay on with regulation.
Right.
But EMDs also provide products to potential investors, right? So they have products on their shelves, right, that they essentially sell, right? So we've done our due diligence, we've approved them, and here you can invest in this product, right? That being said, I would caution you, coming from a pension background and coming from learning from a mentor who really taught me how to do diligence and having an audit background, I personally would be skeptical of an EMD's, like how much diligence have they truly done, right? There's probably some out there that are great, but there's some out there that are just pure salespeople, right? Who don't really understand the risk, haven't really done significant amount of diligence, right? And frankly, they're probably not even investing their own capital in the opportunity, right?
So basically, to recap, EMD is, in my mind, more like a brokerage house that they have a product shelf and then the different products. And these are all private equity products.
Yeah, that's a
so to speak. It's a great way to sum that up, right? So versus you go to mutual funds manager, or you buy mutual funds, right? So that's all the public equities. Most average financial planners will sell you public equities, right? And the private equity salespeople are the EMDR to represent what we call dealer represent the DRs, right? So and I don't know how everybody's exposure is. There are more and more DRs because there are more and more projects. So other than EMDs, would there be some funds that people can buy directly, or like say from this, what you call sponsor, like the developer, the issuer, they call them? Or what about a REIT? Can people just directly buy from these people?
Well, even if you invest in a private REIT, for example, right? Most likely that private REIT is raising capital on a frequent basis. There will be an EMD involved. Like, for example, I was just more curious. I won't name the shop, right? But I was just very curious about a certain apartment sort of issuer, right? Private issuer. So I just, I reached out to them. They immediately, directed me to a third-party EMD who I had a chat with about the suitability. First of all, about the opportunity, but whether it's suitable for me. Right. So chances are, if you're dealing with somebody who's raising capital on a very frequent basis, you will get in touch with an EMD. You can invest in projects directly without an EMD, right? But then the issuer has certain responsibilities.
So you talk about accredited investors, right? So I think a lot of EMDs, they look for doctors because we are mostly high net worth. Right. So can you briefly just tell the audience what's the space about accredited versus non-accredited? They're eligible to like, where do they make the cutoff? But do we fit?
Yeah. So accredited investors, I mean, I think you have to have $1 million in net financial assets. That can include your house, right? Or you have to make, 200,000 individually or 300,000 with a spouse. And I believe it's like a 2-year cutoff, and you have to believe that it's going to persist, right? So that's kind of the definition of accredited. So most doctors, even if they don't meet the net financial asset test, they'll generally make it on the income test, right? And then, there's obviously a path forward to get to that net financial asset test, as long as they, continue to save money and invest properly.
Right. And then for those of us who are a little bit more exposed, I don't know about the audience, but I'm very familiar with this space. So they promise a lot of returns, double digit, like 8-9% prep, and then back end. So it end up with 15, 20+%. So do you think those are realistic? Are these real?
Well,
are they true, or are they poo?
Yeah, I mean, I think they can be realistic, but definitely there can be a game to it as well, right? Like you can put together a model, right? And you can make whatever assumptions you want, and you can create that 20% potential return, right? But I think you have to I think there's a few things you got to look at. Like what I look at, for example, right, is like definitely I want to have alignment of interest, right? With whoever I'm investing with, I want to make sure that they have skin in the game, whether it's through investing hard cash in the deal, plus, potentially putting up their guarantee, right? They don't always have to have everything, but there's got to be some level of alignment of interest. And then you want to see what kind of, do they only talk about the potential gains? Do they even mention any of the risk, right? What's their track record, right? Have they done it before, right? And so those are kind of some of the critical pieces. Do they understand financing? I think that's pretty, especially in real estate, that's very important. So I've met Bob Dylan, for example, from Main Street, right? Which is a public company. He's very successful, right?
Big guy.
Big personality type, right? And, he said, like, in this business, you make money on the buy. And again, he's more value add apartments. You make money on the buy, you make money on the financing. You'd be surprised how few sponsors, like how little finance knowledge they actually have, and how little knowledge they have related to like even financing. Like people send me opportunities to look at from time to time. And I kind of give my input, right? I try to give my unbiased opinion. And someone showed me an opportunity in Winnipeg, and it was $100 million project. And they were using an interest rate that was like 2% below the current market. Right. And so it's like, do you not understand, like, you know what I mean? Like you should have this basic understanding. Right. And the other thing I would say is you have to see, like, listen, you're going to pay fees, right? Whether you invest in the public markets, if you invest in a manager, or you invest in private, there are going to be fees. And sometimes the fees in privates are going to be higher. It is more work to put a deal together versus just investing in a stock. But is there alignment of interest, right? Like, is there a preferred return, for example, right? I was just looking at another opportunity the other day for somebody, and, these guys were taking 40% sweat equity, no preferred return, right? And it didn't seem like they were really putting any cash in the deal. So these are some of the things you should look for, right? When you're kind of evaluating somebody.
Right. So to recap what you say, while they give you very attractive return, and while some of those are actually true, but there's a lot of stuff hidden behind that it's all by assumption. And we have to do some sort of a due diligence.
Or you have to get somebody who knows how to do it, right? Like,
because
who can do it for you.
Or you have to find somebody who could do the due diligence, short for DD, right? A proper DD, right? So, of course, with your background, being an accountant, auditor, and with your CFA, of course, you would know how to crunch numbers. How would average Joe doctor know whether the salesman across the table knows what they're talking about?
I mean, I would say you got to educate yourself, right? So if you want to take the path where you're going to do it on your own, then you definitely have to educate yourself. And it's not that it can't be taught, but you have to invest in that process, right? Despite being relatively educated, right, on the financial side, I think anybody is capable of learning something, but they have to have the time, right? And they have to commit to it, right?
Right. Exactly. Now, so we actually gone over time, but I want to switch over and spend a little bit of time about institutional grade real estate investment. So that's part of our topic. So what would you say is the institutional grade real estate investment project?
Well, you can think of institutional grade as generally, typically they're larger assets, but I think you can do it on the small scale too. You just have to have some of the same structures, right? So let's say when you're evaluating an opportunity, is there a preferred return built in, right? That's probably, that's typically a sign, right? That's like an institutional concept, right? If they don't have that, then it's definitely not meeting that test, right?
So to me, institutional grade is what institutional funds would buy, right? So or they would sell, right? And so if somebody builds a project and the institution would smell you and say, I want to buy you out, then you got institutional grade real estate, right? Because you're worth pursuing. But it's different, right? Because we most doctors have 1, 2, 3, 20 doors of condos, right, or houses, and so these are called moms and pops, right? And then there's a different level, which is the bigger, more sophisticated real estate.
Oh yeah, generally larger assets for sure are considered more institutional grade for sure. Yeah,
and the returns are different, the effort is different, right? And so that will be a discussion for a different day. And okay, so one final question. So yeah, you already answered some of that. For us, what's the next step if we're interested in this? Or our audience is diverse. I know some of the audience already. I talked to you one-on-one. Some already have a huge portfolio, and they are actually walking into institutional grade already. So what's next for people like that, or for the average doctor, if they want to expand?
Yeah, you can consider investing in like these GPLP structures, right? Just kind of keep some of the things that I said in mind, right? When you're kind of evaluating these opportunities, right? And you could talk to an EMD, right? But just again, if you're talking to an EMD, I would say make sure that they're investing their own capital in those same opportunities, right? That's probably one of the first questions to ask them, right? And really understand their due diligence process and who's doing their due diligence.
Right. Yeah. Okay, good. Thank you, Gaurav. It's a lot of questions. It's a lot for people who haven't heard about this. This is quite a bit.
Thank you so much for listening to the Physician Empowerment Podcast. If you're ready to take those next steps in transforming your practice, finances, or personal well-being, then come and join us at PhysEmpowerment.ca, PhysEmpowerment.ca, to learn more about how we can help. If today's episode resonated with you, I'd really appreciate it if you would share our podcast with a colleague or friend, and head over to Apple Podcasts to give us a 5-star rating and review. If you've got feedback, questions, or suggestions for future episode topics, we'd love to hear from you. If you want to join us and be interviewed and share some of your story, we'd absolutely love that as well. Please send me an email at kmilo@PhysEmpowerment.ca. Thank you again for listening.